Hello friends, this is Suryapali. Let us learn some of the key terms and its use in operation management.
Absolute conformance. Absolute conformance is the most rigorous standard of quality because it represents a perfect, or ideal, level of compliance. Absolute conformance. Absolute conformance represents perfect compliance with pre-established levels of quality. Absolute conformance. Absolute conformance is the most rigorous standard of quality because it represents a perfect, or ideal, level of compliance. Absorption cost. Absorption costs are not relevant in situations when management must decide on accepting or rejecting one-time-only special orders, and where there is sufficient idle capacity. Absorption cost. Absorption costs represent an accounting for resources used that are usually consistent with generally accepted accounting principles and include fixed costs that frequently do not change with the selection of different alternates. Absorption costing. When production is greater than sales, absorption costing income is greater than variable costing income. Production in excess of sales result in increases in inventory that include capitalization of fixed product costs that are immediately expensed under variable costing. Since costs that are used in the determination of net income for variable costing are accounted for in inventory for absorption costing will produce higher net income than variable costing when production is greater than sales. Absorption costing. Absorption costing methods represent generally accepted accounting principles generally used for the presentation of external financial statements and are, therefore, for the benefit of external users. Account analysis. The account analysis method is merely a review of all the accounts by someone knowledgeable of the activities of the firm. It is only as good as the person making the judgments. Accounting rate of return. Accounting rate of return is based on accrual income rather than cash flows. It does not consider the time value of money and is considered inferior to the discounted cash flow methods. Activity-based costing. Activity-based costing is an accounting system that collects financial and operating data on the basis of the underlying nature and extent of the cost drivers. Activity-based costing. Activity-based costing focuses on value added by identifying the cost drivers that add value. Activity-based costing. Activity-based costing focuses on value added by identifying the cost drivers that add value. Activity-based costing. Activity-based costing focuses on the cost of activities and seeks to only invest resources in value-added activity. Activity-based costing. Activity-based costing focuses on costs for each activity in a process, but does not strive to stay within a targeted cost. Balance of power. The concept of balance of power anticipates that no one nation will dominate or interfere with the activities of others. Balanced scorecard. The Balanced Scorecard reports management information regarding organizational performance as defined by critical success factors. These critical success factors are often classified as human resource, business process, customer satisfaction, and financial performance. To demonstrate that no single dimension of organizational performance can be relied upon to evaluate success, critical success factors identified in the Balanced Scorecard generally include human resource aspects, particularly as it relates to harnessing employee innovation, internal business process improvement, customer satisfaction, and financial performance. Balanced Scorecard. Financial and non-financial features of an organization that contribute to its success in achieving strategy are referred to as critical success factors and are normally classified as financial solvency and return, customer satisfaction, internal business processes, and human resource innovation. Benchmarks. Benchmarks represent the best practices within an industry or within a function. They may serve as the individual standards that serve to evaluate the achievement of goals classified within the context of critical success factors, but they are not, themselves, the features that an organization must possess to accomplish their strategy. Bonds. Bonds are debt instruments that require specific fixed payments, mature at a specific time and increase debt. Immediately after issue, increases in debt increase the debt-equity ratio and decrease credit worthiness. Break-even analysis. Break-even analysis assumes that all variable costs and revenues are constant on a per-unit basis and are linear over a relevant range. Fixed costs in total are constant. Business process management. Business process management seeks incremental change by tweaking the existing process and design. Business process management decreases financial risk associated with change because the change is incremental and made to an already functioning process. If it goes badly, you will still be left with a process that works. Business process reengineering. Business process reengineering seeks radical change by ignoring the current process and instead starts from the beginning to design a different way of achieving the end goal and/or product. Business process reengineering has a longer implementation time because it involves radical change. Call option. Call options would allow, but not require, the purchaser of the call to acquire the currency for a specified price at or before a specified time in the future. If the price goes up, the purchaser, the importer, would exercise the options. If not, the purchaser, importer, would buy the foreign currency in the market and let the options expire. Used in case of account payable. Callable bond. Callable bonds would fluctuate in value. In fact, one of the advantages to the issuer of callable bonds is the ability to call or, effectively, refinance the bonds if interest rates become favorable. Capital Assets Pricing Model. Capital Asset Pricing Model, CAPM. Cost of capital equals R plus B, M, R. Where C equals cost of capital. R equals risk-free rate. B equals beta. M equals market rate of return. Capital budgeting. Capital budgeting involves the management's evaluation of an uncertain future since it involves long-term commitments for asset acquisition and, often involves long-term financing decisions as well. Management's decisions on the increased requirement for capital investment and the required return and the cost of capital require evaluation of an uncertain future. Coefficient of determination. The coefficient of determination measures the proportion of the total variation in Y or total cost that is explained by the total variation in the independent variable, X, or variable costs. The coefficient of determination measures the reliability of the formula, but is not used for determining the value of Y. The standard error, also standard error of the mean, is a measurement used in conjunction with standard deviation computations and is not relevant to this projection. Collection period. The average collection period for a firm measures the number of days after a typical credit sale is made until the firm receives the payment. Collection period. Average collection period will be decreased due to a change in credit policy because of increase in sales, increase in discounts taken, decrease in the amount of bad debt, and decrease in the investment in accounts receivable. Common stock. Common stock is an equity security that conveys ownership. Common stock does not require any payment, it does not mature and, because it increases equity while having no effect on debt, it decreases the debt-equity ratio and increases the creditworthiness of the firm. Compensating balances. Compensating balances are a bank requirement related to a loan. The bank will require a certain balance be maintained in cash. This amount cannot be used for working capital purposes. Concentration banking. Concentration banking automatically channels funds from every source of the business into a single usable account, thus quickly identifying available funds each day, and moving them to accounts that have funding requirements that day, and investing the remainder in short-term, interest-bearing instruments until needed. Conforming costs. Inspection of in-process goods is an conformation and appraisal cost. Conforming costs. Conforming costs are those preventative and appraisal costs invested to detect and prevent errors and do not represent quality standards. Conforming costs. Conforming costs are those preventative and appraisal costs invested to detect and prevent errors and do not represent quality standards. Continuous probability. Continuous probability simulation is a procedure that studies a problem by creating a model of the process and then, through trial and error solutions, attempts to improve the problem solution. Control chart. Control charts measure conformance of operations within a standard range known as a goalpost, an upper or lower limit. Convertible bonds. Convertible bonds would fluctuate in value. In fact, one of the advantages to the investor, and potentially the issuer, in relation to convertible bonds is the ability to convert or, effectively, swap the bonds for equity if market conditions become favorable. Equity returns exceed fixed return on debt. Cost of discount foregone. Cost of discount foregone equals discount percent / 100 discount percent, x, 360 / allowed payment days, discount days. Cost of discount foregone. The cost of lost discounts is the product of the number of interim periods within a year represented by the credit period extended after the discount period times the effective rate of interest for that period, which is computed as the discount percentage divided by the net amount due within the discount period, also expressed as a percentage. Cost volume profit analysis. Cost volume profit analysis is a method used to evaluate operating decisions. Database marketing. Database marketing involves gathering information on customers and using the information from that database to segment customers into target markets for a more effective selling effort. Debt covenant. A debt covenant is a provision in a bond indenture, contract between the bond issuer and the bond holders, that the bond issuer will either do, affirmative covenants, or not do, negative covenants, certain things. Default risk. Default risk is the risk that the security will not be repaid because the issuing entity is insolvent or illiquid. Delphi Method. The Delphi method of forecasting involves the use of multiple teams in geographically remote locations. Information is shared and gathered in a central point and compiled and then redistributed for comment. The method is highly interpersonal and requires significant judgment. Demand flow. Demand flow manufacturing manages resources using customer demand as the basis for resource allocation. Demand flow manufacturing is not an appropriate response to bottlenecks. Direct costing. Direct costing, more accurately called variable or marginal costing, capitalizes only the variable production costs, direct materials, direct labor, and variable overhead, to inventory, product costs, while fixed costs are expensed as period cost. Direct labor. Direct labor represents the cost of labor directly associated with the manufacturing of the finished product. Discount rate. The discount or hurdle rate is determined in advance for computations of net present value. Project cash flows are discounted based upon a predetermined rate and compared to the investment in the project to arrive at a positive or negative net present value. Advanced determination of management's required return is integral to the development and evaluation of net present value. Economic order quantity. EOQ equals square root 2 so/c. Where EOQ equals order size. S equals annual sales quantity in units. O equals cost per purchase order. C equals annual cost of carrying one unit in stock for 1 year. Economic order quantity, EOQ. Economic order quantity, EOQ, is an inventory model that attempts to minimize both ordering and carrying costs. The objective of the EOQ is to compute the quantity to order. Economic value added. Economic value added is a residual income measure that compares income with required return on investment. Positive amounts indicate objectives have been met, negative amounts indicate that objectives have not been met. The method does not equate investment cash outflows and cash inflows. Economic value added. Economic value added is a residual income technique used for capital budgeting and performance evaluation. It represents the residual, excess, income of project earnings in excess of the cost of capital, including cost of equity, associated with invested capital. E-marketing. E-marketing uses the internet to accomplish marketing functions. Engineering method. The engineering method uses such methods as time and motion study to classify costs. It can only be used where there is an observable relationship between the inputs and the outputs. Engineering standards. The best basis for setting standards is engineering standards based on attainable performance. Tight standards are good, but if unattainable, employees will not be motivated. Executive Steering Committee. Approving project deliverables is a responsibility of the Executive Steering Committee. Expected value. Expected value analysis represents the long-term average of repeated trials and is found by multiplying the probability of each outcome by its payoff and then summing the results. Expected value. Expected value computations that assign probabilities to potential outcomes quantify both the likelihood, percentage, and outcome, amounts, into a single value. Expected value is therefore the most useful of the listed statistics when risk is being prioritized. Expected value. Probability and expected value. The course of action with the highest expected monetary value should be selected. Financial risks. Financial risk is a general category of risk that includes interest rate risk. Interest rate risk is the fluctuation in the value of a financial asset when interest rates change. Market risk. Purchasing power risk. Purchasing power risk is the risk that price levels will change and affect asset values, mostly real estate. Liquidity risk. Liquidity risk is associated with the ability to sell the temporary investment in a short period of time without significant price concessions. Default risk. Financial risk, also called default risk, relates to the exposure of lenders to the failure of borrowers to repay principal and interest on debt. An entity using its own cumulative earnings in capitalizing its operations is not exposed to default risk. Business risk represents the risk associated with the unique circumstances of a particular company, as they might affect the shareholder value of that company. If an entity purely uses its own cumulative earnings in capitalizing its operations, it is exposed to the risks of its own unique circumstances. Fishbone. Cause and effect. Fishbone diagrams typically analyze problems that contribute to the occurrence of defects. Floating rate bonds. Floating rate bonds would automatically adjust the return on a financial instrument to produce a constant market value for that instrument. No premium or discount would be required since market changes would be accounted for through the interest rate. Foreign trade zone. A foreign trade zone contemplates a physical location in which tariffs are waived on imported products until they leave the zone. Foreign trade zones anticipate delay rather than reductions in tariffs. Gap analysis. Gap analysis determines the difference between industry best practices and current company practices. It focuses on quality as it identifies areas that need improvement to meet industry best practices. Globalization. Globalization is the distribution of industrial and service activities across an increasing number of nations. Globalization does not describe the actions of a single company. Goalpost. Goalpost conformance assumes a range of acceptable results. Because it represents achievement of compliance within an established range of tolerable error, goalpost conformance is considered less rigorous than absolute conformance. Goalpost conformance. Goalpost conformance assumes a range of acceptable results. Because it represents achievement of compliance within an established range of tolerable error, goalpost conformance is considered less rigorous than absolute conformance. High-low method. The high-low method is a simplified approach that uses only the points of highest and lowest activity. The regression method considers every point of activity. Historical cost. Historical cost is generally not relevant in a decision analysis situation. Incentive to hold inventory. The amount of inventory that a company would tend to hold in stock would increase as the variability of sales decreases. Cost of running out of stock decreases. Length of time that goods are in transit decreases. Interest rate risk. Interest rate risk is the fluctuation in the value of a financial asset when interest rates change. Interest rate swap agreement. An interest rate swap agreement would be effective in hedging the risk associated with interest rate fluctuations. A swap agreement is a private agreement between two parties, generally assisted by an intermediary, to exchange future cash payments. In case of swap agreement, one party enters into agreement with another party a fixed rate of interest in exchange for receipt of payments of a floating rate of interest. Internal failure cost. In a quality control program, internal failure costs are incurred because non-conforming products and services are detected prior to being shipped to customers. Examples are rework, scrap, reinspection and retesting. Internal rate of return. The internal rate of return is the computed rate at which net present value is zero. Internal rate of return. Internal rate of return, determines the compound interest rate of an investment where the present value of the cash inflows equals the present value of the cash outflows. The is the discount rate that results in a net present value of zero. The internal rate of return, method is less reliable than the net present value, NPV, technique when there are several alternating periods of net cash inflows and net cash outflows or the amounts of cash flows differ significantly. The is strictly a percentage measure of return, while the NPV is an absolute measure. Due to this difference, the timing or amount of cash flows under can be misleading when compared to the NPV method. Just-in-time. Just-in-time management anticipates achievement of efficiency by scheduling the deployment of resources just in time to meet customer or production requirements. Just-in-time. Just-in-time management emphasizes efficiency by scheduling the deployment of resources just in time to meet customer or production requirements. Just-in-time. Characteristics. Specialize in merely one job or task. Specialize in merely one job or task. Coordination of supplies inventory with synchronization of production scheduling with demand and supplies arrive at regular intervals throughout the production day. Reduced setup times that no longer need to accommodate buffers for delivery of goods are benefits and features of just-in-time inventory systems. Just-in-time requires a sense of empowerment amongst employees to ensure the coordination of production and materials delivery is handled with maximum efficiency and accommodates variable schedules. Just-in-time. Just-in-time resources just in time to meet customer or production requirements. Resources just in time to meet customer or production requirements. JIT is not the best response to bottlenecks. Just-in-time. In a just-in-time system, products are produced just in time to be sold. Therefore, JIT systems maintain a much smaller level of inventory when compared to traditional systems. Inventory turnover, cost of goods sold divided by average inventory, increases with a switch to JIT, and inventory as a percentage of total assets decreases. Just-in-time. Just-in-time purchasing systems usually results in a reduction in the number of suppliers. Because a company that adopts JLT is very dependent on supplier performance, usually fewer suppliers are used and a very close working relationship is developed with existing suppliers. Just-in-time. The just-in-time system focuses on expediting the production process by having materials available as needed without having to store them prior to usage. Thus, the non-value-adding operation of storing materials is eliminated. Kaizen. Kaizen, or continuous improvement, occurs at the manufacturing stage where the ongoing search for cost reductions takes the form of analysis of production processes to ensure that resource uses stay within target costs. Lean manufacturing. Lean manufacturing or lean production emphasizes the use of only those resources required to meet the requirements of customers. It is somewhat like activity-based approaches, as it seeks to invest resources only in value-added activities. Lean manufacturing. The main objective in lean manufacturing is waste reduction. Although customer requirements and demand pull serve as the basis for the approach, quality is not the preeminent concept. Lean manufacturing. Lean manufacturing supports the use only those resources required to meet the requirements of customers. Lean manufacturing is not an appropriate response to bottlenecks or constraints. Learning curve. Learning curve analysis is used to determine increases in efficiency or production as experience is gained. Both products have long production runs, making learning curve analysis the best method for estimating the cost of the competitive bid. Liquidity risk. Liquidity risk is associated with the ability to sell the temporary investment in a short period of time without significant price concessions. Lockbox system. A lockbox system expedites cash inflows, minimizes collection float, by having a bank receive payments from a company's customers directly, via mailboxes to which the bank has access. Payments that arrive in these mailboxes are deposited into the company's account immediately. Lockbox system. Lockboxes are systems of mailboxes, usually in many locations, where customers send payments. The company's bank checks these mailboxes frequently and immediately deposits checks received. This accelerates the collection of accounts receivable. Long-term debt. Long-term debt requires specific fixed payments, includes maturity at a specific time and, by definition, increases debt. Immediately after issue, increases in debt increase the debt-equity ratio and decrease credit worthiness. Market value added. Market value added contemplates the degree to which management's actions improve stockholder value. It does not specifically identify multiple dimensions of business performance. Master budget. A master budget is an overall budget, consisting of many smaller budgets. Master budget. A master budget is an overall budget, consisting of many smaller budgets, that is based on one specific level of production. A flexible budget is a series of budgets based on different activity levels within the relevant range. Materials Requirements Planning, MRP. Materials Requirements Planning, MRP, is an inventory management technique that projects and plans inventory levels in order to control the usage of raw materials in the production process. MRP primarily applies to work in process and raw materials. Motive to hold cash. There are three primary motives for holding cash. Transactions demand. Precautionary demand. Speculative demand. Multilateral. Multilateral refers to power that is not only distributed but shared cooperatively among nations. Multiple regression analysis. Multiple regression analysis is an expansion of simple regression because it allows consideration of more than one independent variable. The other elements are consistent in simple and multiple regression analysis. Multipolar. Power distributed amongst multiple nations refers to a multipolar distribution of power. Net present value. The net present value is the difference between the cost of an investment and the present value of its cash flows. Net present value. Net present value equals the present value of the cash inflows minus the original cost of the asset. If the net present value of a project is positive, it would indicate that the rate of return for the project is greater than the discount percentage rate, hurdle rate, used in the net present value computation. When using the net present value method of capital budgeting, different hurdle rates can be used for each year of the project. Net present value, NPV. The net present value, NPV, method of capital expenditure evaluation does not provide the true rate of return on investment. The NPV indicates whether or not an investment will earn the hurdle rate used in the NPV calculation. If the NPV is positive, the return on investment will exceed the hurdle rate. If the NPV is negative, the return on investment will be less than the hurdle rate. If the NPV is zero, the return on investment will be exactly equal to the hurdle rate. Network marketing. Network marketing, sometimes referred to as multilevel marketing, focuses on relationships and referrals to accomplish marketing functions. Non-conformance costs. Rework is a internal failure costs, a subset of non-conformance costs. Rework of products assumes errors are caught and corrected before delivery. Reduction of rework is an indication of improved efficiency and product quality. Product returns create non-conformance costs and external failure costs. Warranty expense is a non-conformance cost, it is an external failure cost, not an internal failure cost. Non-conforming costs are those internal and external failures associated with correcting quality errors associated with non-compliance and do not represent quality standards. Offshore operations. Offshore operations are the outsourcing of services or business functions to an external party in a different country. Offshore operations. Offshore operations are the outsourcing of services or business functions to an external party in a different country. Operating budgets. Operating budgets describe the plan for revenue and expenses and the supporting schedules that go with them. Examples include sales, materials, labor, overhead, production, purchases, and the forecasting of cash that will be necessary to pay for them. Capital budgets plan for the purchase of capital assets, which will only affect the operating budget through their subsequent effect on expense via depreciation. Operating leverage. Operating leverage is the presence of fixed costs in operations, which allows a small change in sales to produce a larger relative change in profits. Degree of operating leverage equals profit divided contribution margin. Opportunity cost. Opportunity cost is the next best use of productive capacity. The production that is forfeited to produce the special order is referred to as the next best alternative use of the facility. Opportunity costs are costs that would have been saved or profits that would have been earned if another decision alternative had been selected. Ordinary annuity. Annuity due factor for cash inflows are received at the end of the year. The annuity due factor would be used if the cash inflows were received at the beginning of each year. Outsourcing. Non-core functions to one business become critical for companies providing outsourcing services, thereby reducing risk exposure in the event an issue arises. Disadvantages of outsourcing. Language barriers. Security issues. Quality of service. Pareto chart. Pareto diagrams combine the elements of a histogram of quality control issues displayed in order of most to least frequent with a line graph that displays the cumulative occurrence of the problems. Payback period. The payback method determines the number of years that it will take for a company to recoup or be paid back for its investment. The payback method does not consider the time value of money. The payback method neglects total project profitability. It simply looks at the time required to recover the initial investment, subsequent cash flows are ignored. Payback and bailout. Payback do not consider the time value of money or the return after the initial investment is recovered. The difference between the two methods is that bailout payback takes salvage value into account in calculating cash flows. Period cost. Period costs are costs that are expensed during a period. They are not charged to a product, capitalized, which is why they are expensed. Pert. Pert is a technique used in project management that focuses on the time required to complete each step in a project. It allows a project manager to monitor a project's progress and identify potential bottlenecks or delays that will postpone the completion date. Portfolio theory. Portfolio theory is concerned with construction of an investment portfolio that efficiently balances its risk with its rate of return. Risk is often reduced by diversification, the process of mixing investments of different or offsetting risks. The broad categories of risk are summarized in the following mnemonic to get us dones. Unsystematic, non-market/firm specific, /diversifiable. Diversifiable risk can be eliminated through effective application of portfolio theory. Diversifiable risks are also termed unsystematic risk. Non-diversifiable/systematic, market, non-diversifiable risk cannot be eliminated by the application of portfolio theory. Non-diversifiable risk is also referred to as market or systematic risk. Prime rate of interest. The prime rate of interest represents the rate offered by banks to their most credit-worthy debtors. The prime rate of return would not necessarily consider the risk-specific return required for a particular company's and would not be appropriate as a hurdle rate. Product cost. Product, inventoriable, costs include direct labor, direct material, and applied overhead. Direct material costs anticipate a provision for normal spoilage. Sales commissions are selling and administrative expenses that are period, not product, costs, and abnormal spoilage is charged against income of the period as a separate component of cost of goods sold. Product cost is assigned to goods, products, that were either purchased or manufactured for resale. Profitability Index. The Profitability Index is the ratio of the present value of net future cash inflows to the present value of the net initial investment. The Profitability Index is also referred to as the Excess Present Value Index or simply the Present Value Index. Companies hope that this ratio will be over 1.0, which means that the present value of the inflows is greater than the present value of the outflows. Profitability Index equals present value of net future cash inflows, present value of net initial investment. The Profitability Index is the ratio of the present value of net future cash inflows to the present value of the net initial investment. The profitability ratio requires detailed long-term forecasts of projects' cash flows. For longer-term projects, cash flow projections might be either unavailable or unreliable. Project Manager. Responsibility for project administration on a day-to-day basis, including identifying, managing internal and external stakeholder expectations. Project members. Carrying out the work and producing the deliverables is a responsibility of the project members. Project sponsor. The project sponsor is an individual at the executive level of management who is responsible for allocation of fund and resources to the project. The role of the project sponsor includes responsibility for overall project delivery. Project sponsor. Interfacing between the organization and the project itself is a responsibility of the project sponsor. Put option. Put options would allow, but not require, the purchaser of the put to sell the currency for a specified price at a specified time in the future. Used in case of account receivable. Quality cost. Quality cost is divided into two categories. Conformation cost - cost incurred to conform the product to quality, further subdivided into 1. Preventive cost and 2. Appraisal cost. Non-conformation cost, cost incurred due to conformation product, 1. Internal cost and 2. External cost. Prevention - cost incurred to prevent from happening - preventive maintenance, redesign of processes. Appraisal - cost incurred to detect the defects. Examples of these costs are testing, statistical quality checks, inspections, testing, maintenance of lab. Internal failure - cost incurred to correct the defect, and these costs are incurred before sending the product to customer - tooling changes. External failure - cost incurred to correct the error to fix the defect detected by customer - responding to customer complaints is an external failure cost incurred because products or services failed to conform to requirements alter being delivered to customers. An increase in conformance costs, prevention and appraisal, resulted in a higher quality product and a decrease in non-conformance costs, internal and external failure costs. Regression analysis. Regression analysis is a statistical model that can estimate the dependent cost variable based on changes in the independent variable. Regression analysis. Regression analysis is a statistical method that fits a line to the data by the method of least squares. It is the most accurate way to classify costs of an object as either fixed or variable. Relative sales value. Sales price less the cost to complete is defined as the relative sales value at split off. In other words, this is the additional contribution to income generated by completing the product. Relevant cost. Relevant costs are costs that are relevant to a particular decision. The relevance of a particular cost to a decision is determined by potential effect on the decision. Relevant costs are expected future costs that vary with the action taken. When considering alternative, such as discontinuation of a product line, management should consider relevant costs. Relevant costs are those costs that will change under different alternative. Residual income is the segment margin of an investment center after deducting the imputed interest, hurdle rate, on the assets used by the investment center. Residual income. Residual income methods, including economic value added, focus on target return and amount and encourage managers to invest in projects that exceed the hurdle rate. As a result, divisions with high rates of return do not fear dilution of their rates and are not discouraged from making investments that demonstrate strong residual income performance. Return on investment, ROI. Return on investment, ROI, measures may discourage managers from avoiding investments that could benefit the company as a whole. Use of the ROI exclusively as a measure of performance can inadvertently focus managers purely on maximizing short-term returns. Profitable units are reluctant to invest in additional productive resources because their short-term result will be to reduce ROI. Risk-averse behavior. Risk-averse behavior occurs when an investor's risk-expected rate of return. The investor seeks higher returns for more risk. Risk behavior. Risk-averse behavior describes managers who demand more return on an investment as risk increases. These managers expect to be compensated for increased risk. Risk-seeking behavior describes managers who seek reduced return for higher risk. Risk-indifferent behavior describes a manager who is neutral with regard to the return associated with a particular investment. Typically, the amount of a risk-free rate of return associated with an investment of a given amount compared to a higher return associated with higher risk is one awed as having equal value. Risk-indifferent behavior. Risk-indifferent behavior occurs when an investor's risk equals expected return on the investment. Risk-indifferent behavior describes a manager who is neutral with regard to the return associated with a particular investment. Typically, the amount of a risk-free rate of return associated with an investment of a given amount compared to a higher return associated with higher risk is viewed as having equal value. Risk premium. Default risk premium, DRP, is the additional compensation demanded by lenders for bearing the risk that the issuer of the security will fail to pay interest or fail to repay the principal. Purchasing power risk premium, or inflation premium, IP, is the compensation investors require to bear the risk that price levels may change and affect asset values or the purchasing power of invested dollars, example real estate. Maturity risk premium, MRP, or interest rate risk, is the compensation investors demand for bearing risk. This risk increases with the term to maturity. Risk-seeking behavior. Risk-seeking behavior occurs when an investor's risk-expected rate of return. The investor seeks higher returns for more risk. Safety stock. Safety stock levels are affected by uncertain sales forecasts. Greater uncertainty means a higher level of safety stock should be carried. Dissatisfaction of customers. If customers are dissatisfied with back orders, which occur when there are stockouts, then more safety stock should be carried to prevent stockouts. Uncertain lead times. Greater uncertainty means a higher level of safety stock is needed. Scatter graph. The scatter graph method is used in statistical analysis to plot relationships between variables to determine a line function that best describes those relationships. Shared services. Shared services would involve splitting the cost of a service with another organization, not contracting out with a separate entity. Short-term debt. Short-term debt requires specific fixed payments, includes maturity at a specific time and, by definition, increase debt. Immediately after issue, increases in debt increase the debt-equity ratio and decrease credit worthiness. Six Sigma. Six Sigma emphasizes cost reduction above production constraints. Sourcing. Sourcing requirements generally refer to content or value-added limits on the percentage of labor or materials used in imported products. Compliance with limits may result in tariff reductions. Standards. Standards imposed by management without employee input are referred to as authoritative standards. Standards developed in collaboration with employees involved with the work are referred to as participative standards. Ideal standards are based on optimum condition. Attainable standards represent per unit budgets that assume normal conditions. Theory of constraints. The theory of constraints is concerned with maximizing throughput by identifying and alleviating constraints. Theory of constraints. The theory of constraints says that organizations are impeded from achieving objectives by the existence of one or more constraints. Organizations or projects must be operated in a manner that either works around or leverages the constraint, in this case, the bottleneck. Throughput cost. Throughput costs represent the costs associated with conversion of resources into a finished product and do not represent costs that will change in the event of selecting between different alternatives associated with abandoning a segment. Total quality management. Total quality management strives to please customers by improving their products. Total quality management is driven by customer satisfaction and continuous product improvement. Total quality management strives to please customers by improving their products. Total quality management, TQM, represents an organizational commitment to customer-focused performance that emphasizes both quality and continuous improvement. Transaction marketing. Transaction marketing involves attracting customers for a single sale. Uncontrollable risks. Uncontrollable risks are, by definition, not within the ability of the manager to mitigate. Like sunk costs that will not change regardless of priorities, uncontrollable risk is not useful when prioritizing risk. Unilateral. Action taken by a single nation acting on its own is referred to as unilateral. Unipolar. Power concentrated in a single nation is referred to as a unipolar distribution of power. Value-added costs. Value-added costs are those resource uses that provide value to the consumer. The cost of inventorying products, generally moving, handling and storing them, does not add value to the product and is generally considered one of the most significant non-value activities/costs that a manufacturer should reduce because it can be controlled. Value-added tax. A value-added tax is an incremental tax, not a reduction in tariffs. Value chain analysis. Value chain analysis is concerned with the additional value a product gains by passing through all the activities in the production chain. It is not focused on ensuring costs stay within a targeted range. Variable costing. Variable costs are those costs that increase or decrease with changes in production. Variable costs do not embrace all costs that will change in the event of different alternatives, only changes in production. Variable costing. Variable, sometimes called direct, costing is used for the benefit of internal users. Variable costs excludes fixed costs from product, inventoried, costs and thereby produces a contribution margin-based income statement highly useful to internal managers in computing break-even points and other analysis of performance. Variable overhead efficiency. The formula for the variable overhead efficiency variance is computed as budgeted variable overhead based on standard hours minus budgeted variable overhead based on actual hours. The sole difference between these two calculated amounts is the use of actual compared to standard hours for overhead. Zero balance account. Zero balance account banking represents an account that maintains a zero balance. Zero balance accounts are accompanied by a master or parent account that serves to fund any negative balance and is designed to maximize the availability of idle cash, not control receipts. Zero coupon bonds. Zero coupon bonds has, in effect, a fixed stated rate of return that would require assignment of a premium or discount to the underlying security to produce a market rate of interest if that market yield is different from the stated rate.